Hello everybody, and thank you for joining today's Seasonax webinar with the title Benefit from Seasonality and Events with Seasonax. My name is Christoph Zenk and I'm the Managing Director and co-founder of Seasonax, and we got something really special for you tonight. I'm really honored to introduce my business partner and the head behind Seasonax, Mr. Dimitri Speck. Besides Seasonax, Dimitri is also the founder of Seasonal Charts, successful book author and trading signal developer. And as managing director and founder of Seasonax Capital, he was awarded for the innovation trading algorithms he developed. And Dimitri will introduce you to seasonality, talk about its origins, and also explain how to take advantage of it. And additionally, we got something really special for you today. For the first time ever, a completely new feature will be displayed, the so-called event studies. And today's event will be recorded. We will publish this video soon after the webinar itself. And one last notice from my side before I hand over to Dimitri, as we are planning to improve this feature in the future, please reach out to us or to our support and give us any feedback and what you think about it. I hope you enjoy the webinar, and I'm handing over to Dimitri to start with his presentation now.
Hello, everyone. Thank you, Christoph, very much for the introduction. Is my screen visible?
Yes, it's looking good.
Okay, I switch off my camera. You too, maybe. So, yeah, welcome to everyone to this very first Seasonax webinar, by the way. Today, I would like to introduce you to seasonality in a way how I am using it. Maybe I can give you some inspiration how you can best make use out of seasonality in Seasonax. And further, as Christoph already mentioned, we have a new feature and we are very proud of this. These are the event studies, which I will also introduce to you. This is an additional feature to seasonal studies, and I think it has a high value for every investor and trader. But let's go to the basics first. Seasonality exists in indexes, which is quite well known, in stocks, in currencies, commodities, which is also quite well known, and bonds. Why do I mention here especially stocks? Because the seasonality of stocks gives you the advantage to have at any period of the year an outperforming, seasonal outperforming stock, and it gives you the possibility for diversification. But also currencies and commodities and commodity futures, by the way, have huge possibilities for seasonal investment. And until now, Seasonax focus, of course, of the normal annual seasonality. But there are also other calendrical effects like intra-month effects, intra-week effects, intra-day effects, and of course recurring events, and this is what I'm very proud to introduce to you today. Let's go to a very basic seasonal pattern, very simple. This is sell a man, go away, or also known as Halloween effect. What you can see here is the Dow Jones equity line, the performance of, in blue, the winter half, and in red, the summer half since 1960, so over 60 years. And you can clearly see that the performance is huge in the winter half and virtually not existent over this long period in the summer half. What does it show to you? It shows you that there is some value behind seasonality. This is a stable pattern so long, despite it's already known since so long. And it's very simple, of course, with Seasonax, you can do much, much more sophisticated things. Let's go to the next. This is the UK. Yeah, also Halloween effect. In red, you see the summer half, which makes it hardly to the 0 line or to the 100 starting point line. In blue, you see the FTSE, and in green, the winter. Again, the winter beats even the FTSE in total over this period of 1984. And let's go to the third chart. This is Germany, the German DAX from the 1970s. You see again, the summer does not make it. Yeah, in blue, you see the DAX, and in green, you see the winter. And the winter does beat again the DAX And in this case, the DAX is a total return index, so it's included, including dividends. What do you want more? It shows you clearly that seasonality does works. Now I go with the table. This table shows you for the 11 biggest country markets by market cap, the performance from the summer half compared to the winter half. And you see that in average, the summer half does not present any profit and the winter half does it all. And you see some countries like Taiwan, where the difference is huge. Yeah, -3 compared to +13. Yeah, this shows you that's not only interesting to look in this particular phenomenon, but also to look where it's worked good, because of course Salome and Go Away is well known in US and in Europe, but there are also other countries, as you can see here clearly. And you see also that there are some countries like India where it does not work so good. Yeah. So this is seasonality. There is something behind, but this is only a very simple approach only for indexes. So how to improve it? These are the seasonal charts, which you can see immediately in Seasonax as soon as you select an instrument, like the DAX or the Dow Jones or Apple stock or whatever. And then you see the seasonal chart, which is the average return of the selected amount of years, 10, 20, 30, whatever. And we have on the left here the chart which shows you these returns of a particular instrument year by year, on the right then the result. Just as an information, the mathematical issues here behind are so that many seasonal charts which you might see in the internet depart from Seasonax are simply wrong. They deal wrongly with the average, they deal wrong with the turn of the year, they deal wrong with the non-trading days and so forth. So if you want to see a precise, mathematically correct calculated seasonal chart, just take Seasonax. And here the first example of a seasonal chart as a reminder. This is the S&P calculated over 25 years. You see the calendarian months over the x-axis, and the y-axis shows you the performance. And here you have immediately the same like the Halloween effect, but much more imprecise, with much more details. You see, for instance, that from mid-March to beginning of May, the stock market on average did rise. Then we have this red arrow, which shows you that then we have this weak summer month. And then you see that from the second week or so of October, the market also already starts to rise. So earlier than the sell in May and go away effect or Halloween effect says to you. And this is something, the advantage of the seasonal charts, you see immediately precise the performance between two calendarian days. Yeah, and not only the beginning or ending of the month or something like this. Now coming to Microsoft, why do I show you the seasonal chart of Microsoft? It has a personal reason. Because, of course, I'm dealing with seasonality since 20 years with seasonal charts. But Microsoft, this example, what you see here, was the very first that I was myself convinced that there is also something behind seasonal in particular stocks, not only in the indexes or in the commodities. You see here the seasonal chart of Microsoft, and you see marked the best period of the second week of October to the first week of November. And this rise is huge. And it's around about the same rise in this few weeks like the total return of Microsoft. And what did I do? Several years ago, I looked at this. What is the reason? And what I found was very interesting. There were earnings surprises. I compared the real earnings quarter by quarter with the expected earnings. And in this quarter, which comes out in October, the earnings surprises were much larger than in the other three quarters. So this is the reason behind this pattern. And this convinced me that there are particular reasons for stock sector or for a particular individual stock which causes seasonal movements. And if you have these reasons, you have, of course, a probability that they repeat. And you have then the chance to make money with it just by being in Microsoft in this particular time of the year, and in others to be in another stock, which has another pattern, maybe with another reason. Another thing is, of course, the Forex market. Here you can see the example of the euro against the US dollar. And the green arrow shows you that the euro does rise in December, and it drops then, as the red arrow shows, exactly starting from the turn of the year in average. And if something turns exactly at the turn of the year, it has probably a bookkeeping reason. This pattern is known already since the 1970s, according to Larry Williams, a quite well-known trader. He told it to me. And it is based on bookkeeping, because the companies, large companies in US, shifting their money out of US to daughter companies to reduce the tax payment. And then after the turn of the year, this effect turns or the money flows back. This is the reason behind. I have also asked years ago a friend of mine who was working for a big US oil company, and he confirmed me that they are doing such things, or this thing in particular. So you have another fundamental reason in another market, in the currency market, for a seasonal pattern. And here I list you just some of the few possible reasons for seasonal patterns. This is, of course, very first the weather, heating, harvesting, and so on, which plays a role. Then in the financial market, window dressing. For instance, before reports or quarterly earnings of funds and so on, there is window dressing. Particular stocks are being bought, etc. Then we have taxes, which I just showed you. Then very important are emotions. You know that emotions play a role in the stock market, because in good weather, or when the soccer company of the country wins, then the stocks typically rises. So emotions affect trading. This is known. And for instance, in my opinion, the so-called Christmas rally is mainly driven by emotions, because the people are in good mood and in a shopping mood. Why not also buy some stocks in a thin market? Then we have decision periods. This is, I've found, and maybe I show you depending on the time, in commodities like nickel or platinum or palladium, meaning that the companies, the decision makers in the companies, look back to in December to the year how it was, and they say, let's say we have sold 10 million catalysts, and they make an looking forward, and then they think, okay, maybe next year will be a little bit better, maybe 10.5 million catalysts. For that we need this or that amount of palladium or platinum, and then they order in this period of time. So this is, for these metals, by far the best period until end of February. Then we have another thing connected with mining and such things. This is the extracted material, meaning, for instance, if crude oil has a seasonal pattern, we should also look at ExxonMobil or other companies, whether they follow this pattern. Then we have money flows, of course, which causes seasonal pattern. We have industrial fairs. If there is some fair, and in this fair many companies get new orders, of course this influences, and it goes through the media, it influences the market. And we have earnings surprises as shown, and so forth. So there are many reasons why seasonal patterns exist and have the tendency to persist. So far about seasonality. I will show you, of course, also soon in the app how I'm using it, and maybe I can give you this or that idea. But I want to show you now the very new feature, event study. We have currently about 80 event studies which can be combined with any of the instruments in Seasonax. And this is such an event study. This is also an average chart, but calendrical, but around the event. In this case, it shows you the 15 days trading days, by the way, before and after the last time 39 time the Fed did hike rates. Yeah, a small reminder, in about 2 hours the Fed will the FOMC board will make its announcement and probably will hike. And you see this is the average trend around this. Yeah. And there we have many patterns, and this is what the event study shows to you. So this is not a seasonal chart like you are used to. It is an event study chart, yeah, showing you the average trend before and after the event. And this is quite typical, this pattern, and something arises ahead of the event. But we will show it live soon more in detail. Here another event. This is a future expiry. We have several futures expiries like quadruple days and so on for the stock market. Here I selected the VTI future, the crude oil future. This is 300 times of the last trading day of this future. So this are a lot of events. This is not a small number statistically. And you can clearly see that the VTI, the crude oil, drops 3 days ahead and then continuously rises after the expiry of futures. Now, this is one more example. And back to the stock market. Here we are Austrian in Europe company. And I show you the Austrian index RTX. Austria once in the 19th century was not only an empire, but also had a very big stock market, by the way. Now compared to US and many other markets, it's of course very small. So this chart shows you 10 days the trend of the RTX 10 days ahead and after the US labor market report. Again, 300, so statistically quite a lot. And you see a continuous rise and then a slight drop. Similar pattern, of course, in the US. Yeah, but in RTX it's stronger, and I just thought it might be interesting to just show you also variation. Other markets which are also influenced, in this case, by the US labor market report. Yeah, so this is what we have. We have currently 80 and probably will have soon 100 events. It's our goal. We have it in groups, central banking actions, so not only Fed hikes, but many more. There are many more central banks and many more actions of central banks. We have elections. Yeah, I will show you an example. I think maybe the German Bundestag election, the futures expiry, I showed you holidays. We have Easter and many other holidays. In China also, we just had the week, which was the holiday week in China. We have reports. I just showed you an example, the labor market report, CPI, and there are many, which are influences in the market. We have calendrical. Yeah, I will show you also then live. I think that's more easy. And like turn of the month. So you can also check these effects as event. I will show you. Yeah. Then a few practical things regarding seasonality. I will start with this, which also apply, of course, then on event studies. In general, we are always only looking as a pattern, which is here marked. Pattern means we don't have, some people think, is there seasonality in the market? Yeah, but in reality, there are patterns, there are seasonal patterns like here marked. And that means there are seasonal trends caused by some reason, whatever it is in this particular case. And the seasonal pattern has this reason, and another period, we saw it in Microsoft, in another period we have other reasons for seasonal movement, or no seasonal movement at all. Yeah, so this you should be always aware. And I will show you then how to deal with these figures. It's always good. You see the bar chart with the pattern returns, if they are quite even, more or less. This is of some importance. You might think how many? I think at least 10. Yeah, in the field of stocks, at least 10. The more, of course, the better. But more important is that also the current 5 years or so have a good pattern return. And you see the equity line, the cumulative profit on the left. If it goes quite nicely up, it also means that this pattern is quite stable. And you see on the on the top right, you see this circle, which is one of the things I look first, because it shows you the annualized performance, which is 73.2% here, compared to the rest, which is 1 point something here. And why do I look at it? It shows me, it confirms in this case, because in this chart it's also visible, but it shows me if there is a huge annualized performance in this particular period versus the rest of the time, that this is most probably really a seasonal pattern. Yeah, and not just an interesting move in the chart, which stands by whatever reason optically out. How do I trade seasonality? One possibility which I'm using, and for this I have the screener, which you also have, is I select in any period of the year some stocks and go in those which are seasonal positive. Yeah. In this case, I selected the Danish medical company Novo Nordisk, which is typically rising in February. And here in March, April, I choose here Adidas, this German sport company. And you have in each period of the time and the year a benefit in the form that there is a seasonal pattern significantly higher than of the market. And for this, I use the screener. I will show you, we have also implemented the screener now for European sectors. So if you are, for instance, convinced that, let's say, banks are coming, the financial sector or another sector, you can screen this particular sector for a nice, interesting stock now. And the second approach, I know that probably most of you are using. This is a mixed approach. That means using your existing approach, which might be fundamental or a technical trend or a mix of everything, and add this seasonality as filter or as some other criterion. And here you see a trading system which is live since the 1990s. So it's not backtesting, no, and it's really live, so-called Gebert system for the DAX. And it's a just plain simple mechanical system with 4 input factors: interest rates, the trend of the dollar, the trend of inflation, and seasonality. And the right bottom chart shows you the trigger line and the DAX. And the right up chart shows you the result in orange of the system, and in blue the buy and hold, so the DAX. And you clearly see how much it outperforms. This shows you 2 things. First, seasonality works. It's one more confirmation that it works. And second, you can easily add it to your current trading approach. Don't hesitate, especially we have done Seasonax in a way that you don't need to spend a lot of time. Yeah. So just add it to your existing trading approach to improve it. Yeah. And I tell you something which is not just a guess, but based on science also. Here, one scientific study, you find more details also on our website. It shows you a long-term, it checked it over 200 years in 68 markets. And it shows you that from the 6 tested trading approaches, seasonality is on the top 3. Yeah. So it's better than value, which is very popular, for instance, and what might come, by the way, this is my personal trading opinion, if I may add it, after, but seasonality adds value. Yeah, this is here confirmation. And believe me, this scientists have a very simple seasonal approach, not what you can do with Seasonax. So I switch into the app. This is what you see and what you know. And let's make a few things to show you how I'm using it. First, I'm taking here these tips from the computer, and here from us, you know them probably. You just click on it, yeah, and it shows you an interesting pattern, yeah. And this pattern here, once again, on the circle, we have 110% annualized return versus 23 rest. So this is a seasonal pattern, yeah. And we have a hit ratio 10 to 0, which is quite good. But on the other side, there's also an uptrending stock with 25% average return, almost 23. So then the chance, of course, to have a good winning trades ratio from 100% is, of course, higher. But in total, the bar chart is okay. It's quite nice. And yeah, the last year was not so good, but the last year, you might remember, 2022 was a bad stock year. So if this pattern in this particular year is not so well, it does not matter a lot. Yeah? So let's go back. And we have here more. These recommendations are done manually. Yeah, the other is done by the computer, by the way. I show you again. You can also switch here to other markets. Yeah. So these are manually done. I go, for instance, to CME group. It looks quite interesting. As they are manually, there are, and of course, still there, despite we have already here the beginning of February now. Yeah, so they will be updated soon. And you can see again, the pattern returns are quite good. The annualized return, 80% compared to 15 is quite high. 80%, by the way, don't expect that you get this 80% again. Yeah, this is just a figure to show you how strong this pattern is. Yeah, I mean, but you have a good chance for an outperformance in average if you trade this. Here we have the detailed statistic. I personally look more or less only to check the things. I know from our customers that they use this detailed statistic also, for instance, to set stop losses. Yeah. Then if I have a particular stock in mind, we had in this case Adidas. Yeah, I just type it here. Yeah, I go here longer. Let's do it here, let's say here. And this is the trend of Adidas. Yeah, good trend. And here you see the bar chart in the middle, that virtually all years are good. Last year was a bad year anyway, so yeah, it's not so. Yeah, we have 66% annualized return, which is less, of course, but also the period is longer. Yeah, the period here you can see is 52 trading days or 76 calendarian days. Then, of course, the average return is lower. But in total, this is a quite good pattern, even especially if you compare 66.78% compared to minus 4.02% in the rest of the year. So that whole gain of Adidas was appeared in this period. Yeah, and here you probably know this filter section or the compare section. You can filter out, of course, 22, which was a bad year, or I just filter it in. Yeah. Here you see that the stock did drop here in red, and yeah, this is the reason why the bar chart of the return for 22 was weak, because this was a weak year. It's also for this company. And you can make here also detrending, by the way. Here you see that the detrended, and in this you see also that the most weakest part was not in this marked period. So even in the downtrend, it was a quite good period, not so bad. Yeah, let's go to commodities. I mentioned VTI. Yeah, and let's go also here longer. For commodities, I really prefer longer periods, because commodity seasonality should have a fundamental reason which does not change so quick like in the stock market. And we have here a nice trend. I will mark it. Yeah. And this is quite interesting. We have 137% annualized return, and then the rest minus 6%. So yeah, this return in this short period, which I just had marked, is better than the whole crude oil performance.
Dimitri, I'm sorry to interrupt you, but there was one question. What exactly is trended?
Detrending, I will show you soon. Yeah. I come to an example where I can show you. Yeah.
Thank you.
And We have here the VTI, yeah, and this good period, and better than the whole thing. And we can look then, for instance, what are stocks doing in this period, yeah. We could look, for instance, what is XOM doing, or we add it here. ExxonMobil, yeah. Okay, it's not so much rising, yeah. So in this case, it does not work, yeah. A little bit maybe, yeah. But in other markets, it works quite a lot, yeah. And now to your question, I show you Apple. I remove the filter here. And you see Apple was a stock which did rise quite a lot, yeah. Here, and if you want to see the seasonal trend good, in a better shape, you can use this detrending, which means that the start point of the seasonal chart and the end point are the same, and the whole trend, which is in Microsoft, in Apple, an uptrend of over 30%, 32% in average, is day by day reduces here the trend. And the advantage of detrending is simple, that you can see the trends, the seasonal trends better, especially trends downwards. Yeah. So if you think, for instance, that the technology stocks will be weak still some 2 years or so, like after 2000, yeah, and you want to short a technology stock, where are the good trends, the periods, the seasonal periods? And if you detrend it, you see it better, because here, for instance, it goes down. Yeah, I will mark it. And here you see it also, that it goes sideways, but with detrending, you just see it better. Yeah. So it gives you a clearer picture of the seasonal trend. So let's go to the screener again, which is a very important tool to find stocks, yeah, or also commodities. Yeah, you can select. We have also here, just as a reminder, we can screen also European indexes, for instance, or US sectors. Yeah, if you think that utilities or energy stocks are interesting now, you just screen them. We have now also European sectors. Yeah, we have other indexes if you are trading, for instance, Indian stocks or whatever. Yeah, so yeah, we have a huge selection, commodities also, and the personal basket, very important. You can make your own basket, even several, and they are then screened. So if you have a wish list or a universe list where you are typically investing of 100 stocks, and they have this and that and this stock, you add it in the basket and you screen your personal basket. Yeah. So I go let's go for a sector. Energy, I already mentioned. Yeah. You can here now change the starting day. You can change the examination period. Here I go longer, yeah, because typically I'm interested in longer period. You can apply a filter, but don't put the filter too strong, yeah. And you can also go select for shorting, yeah. And then you go in the stock, yeah. And this is a quite interesting pattern. Yeah, but of course, manually you can place it much better. I would say this is a good period. I also increase it here to 25 years. Yeah, okay, we have here in 2020, very good year. Maybe I should filter 2020 and 2022 out, because these are really very good years. But it's still a very good seasonal pattern of the stock. Yeah. And yeah, this is, you can again compare it with VTI, for instance. Yeah, what we did with Exxon. And here we have a closer relation. Yeah, now in red is the VTI crude oil seasonality, and in blue is this energy stock, EQ2. So this is an example. I saw it also in gold mining and silver mining and in base metals, that there are these stocks are moved by their underlying commodity with their mining. Yeah. Then let's go once more to the screener, which is, as I told you, a very, very important tool. And just as an explanation, yeah, we have here the Dow Jones average, and I prefer this ranking. It's my own invention, but you can also sort by other criteria. If you prefer, let's say, the Sharpe ratio, yeah, then you go here, or you prefer the annualized return as pattern, yeah, you select it here. I have done this ranking, which is a mix of several approaches like annualized return, average return, detrended return, and so forth. And I think it gives you a good guess of upcoming events. And typically, don't look only at the very top. There are also, in the depending, of course, of the size of the universe, Dow Jones does not have so many stocks. You can also go to 10 or 20 if it's a S&P, or even further. Yeah, these are interesting stocks. Yeah. Okay, then let's go to our new feature, the event studies. Here you see the S&P 500, the seasonal trend. This is how you make an event study. You select first the instrument, and then you go here on the left to events. Yeah. And yeah, I go again to 25 years. Yeah. And here you can select the events. As I told you, these are many, many events. Yeah, and I show you the Fed rate hike, yeah, which was also in the presentation. Yeah. So we have here 39 events in 25 years. These are not so much. Yeah, let's go to another event, which is much more frequent. This is a meeting itself. Yeah, and this is particularly interesting. In the year 2011, there was a scientific study published in the, at that time, most prominent journal of financial journal and the Journal of Finance by two scientists. One is now the head of the Bundesbank Scientific Research, and they published about this pattern. Yeah, a whole article, and this article was awarded. And here you can get a similar an examination of this pattern with a few mouse clicks. Yeah, and they found out that in this period, in these 2 days, the S&P is significantly rising. Yeah, once again, these are 200 Fed meetings in 25 years. The Fed is meeting 8 times a year. Yeah, and from the 2 days before until the close of today, a second day of the meeting, you have an annualized return of 71% in these 2 days. This is a equity line, the cumulative profit is statically rising. You have a ratio of profit which is 63%. This is not so good. Yeah. So it's, but consider we have 200 events. And if you look here at the average return in these 2 days, it's 0.39%. If you have 8 meetings a year, you have more than 3% average return. Yeah. So in 16 days, you have more than 3% average return, whereas the whole stock market has, that is more than half of the whole stock market did. So in these 16 days, you do a slightly higher performance you could have done than the whole rest of the year, which is 235, 240. Yeah. So this is what the power of events. It shows you quite clearly. And yeah, let's go through other events, maybe reports. Here you have German, US consumer price index, GDP, and so on. Labor market report I had showed you for the ATX, for the Austrian market. You see here the same uptrend until the report, but then that we have here one rising day, which was not in Austria. Yeah. Then I think I mentioned elections in my presentation without showing you. This is the DAX. I go again to events and I select the German election. Yeah, this is here. Where is it? German Bundestag. And then I select the maximum, which is unfortunately only 35 years. Yeah, because I did this I published the study since the 1950s in the Financial Times Deutschland, Germany. At that time, it doesn't exist anymore. And we have an uptrend to the election and mainly a downtrend after the election in Germany. You must know that in Germany, after elections, there are typically we don't elect, like in US, a president. We elect parties, and the parties go in hugging and dealing what comes out. And obviously, the investors are then, on average, disappointed. Yeah. Then I show you something that let's go to the events again. We have really a big selection. Yeah. For instance, also things which are, how to say, not very reasonable, maybe you might think, like full moon or lunar eclipse. These are also to disprove an approach. Yeah. Let's go to major commercial accidents and take an airline. Let's say the German Deutsche Lufthansa. Yeah. I go to maximum here, and you see virtually nothing. So this accident and the days after it, there is no strong down move or whatever. Same with Delta Airlines or American Airlines and so forth. So in 27 airline accidents, there is nothing to the airline companies. So you can also, if you have the stock and something happens, you don't need to sell it. It's also an information that there is nothing. Yeah. But let's go back to the things where there is something. Let's go to the bond market. Yeah, this is ETF in the bond market. I go to 20 years. And let's select central banking thing, or let's here, futures expiry. Yeah. Here you can see that it goes sideways until the future expiry, and then the bond market typically rises. These are 80 events in 20 years. It's not so good like 200 events, which we had in the other field of central banking, but it's still not bad statistically. Yeah. And I would also like to show you here these calendarian events. Yeah. How to use them. Let's go to India. So here we have turn of the month, and you want to know, is there a turn of the month effect in India? Yeah, you select the first day of the month, and you see here the performance of the Indian stock market around the turn of the month. So 2 days before and until 1 day after it, there's a huge outperformance. Let's look at the figures. We have in these 3 days, we have an average return of almost 0.9% in the Indian market. The turn of the month effect for the US is well known, of course. You might have heard it. There are several scientific articles and studies, and also many articles and blog entrances and so on. And here you can just with a few mouse click check this turn of the month effect here, in this case for the Indian market. And you also see that it's quite static, the equity line. Yeah, here it had some weakness. So also in India, we have a turn of the month effect, which is, by the way, much stronger in the meantime, like it is in the US. So you can apply all these events for all, here I show you once again, yeah, how many we have on all instruments that you are interested in. Yeah. So once again, you select an instrument like the NASDAQ, then you go to events, and then you go here to event, for instance, Fed meeting, which we just had, and you see it. Yeah. And here, better, of course, these are 79 events. If you increase the figure to 199, yeah, because today, the event of today is not included. It should be 200 then. Yeah, or it will be 200 starting from tomorrow or the day after tomorrow. Yeah. So we have this rise to the Fed meeting, which this scientific study was about, award-winning study. And then you can make any statistics like you are used already from seasonal patterns. This is very similar done here. Yeah. And yeah, if you are satisfied, you can, for instance, buy the stock earlier. And it shows you once again that it's really important to make the statistics. Yeah, because most people are looking at the Fed meeting itself, at the outcome. Yeah, there is a high volatility, most likely also in now 1 hour and 15 minutes. Yeah, but the interesting period statistically is ahead of this. Yeah, so use this feature, and of course you can still use the normal seasonality. It does not disappear. And yeah, I hope could give you some impressions how to use Seasonax, how I am using it, how you can benefit from it. And I wanted to show you this event studies, which we are very proud that we have it now. And yeah, this is it for the moment.